In this unit, we've been focusing on accounting for manufacturing companies. So far, we've defined what type of costs get capitalized as inventory. So we've defined product costs for purposes of preparing financial statements as the cost of direct materials, direct labor, and manufacturing overhead. Manufacturing overhead was that catch-all account that contained all costs incurred in connection with the manufacturing function of the business that don't qualify as direct labor or direct materials. We've also looked at the flow of those manufacturing costs through the various inventory accounts on the balance sheet, and then finally, when they're sold, into cost of goods sold on the income statement. What we haven't done so far is really talk about how we actually assign costs to particular products. Most manufacturing firms will use a variation of either a job order or process costing approach. Here in this course, we're going to focus on job order costing because I think it's the simplest to understand and envision. Job order costing is generally used when a company produces distinct or customized products, where process costing is used when companies produce a lot of homogeneous products. Your textbook also discusses process costing, so please take a look at that if you're interested in the other approach. Previously, when we prepared financial statements for manufacturing companies, we used what would be called an actual costing system. In an actual costing system, companies put the actual cost of direct materials, direct labor, and manufacturing overhead into their work in process account. In reality, most companies use a normal costing system. With a normal costing system, they assign the actual cost of direct labor and direct materials, but as far as manufacturing overhead goes, they instead assign an estimated amount of overhead to their products. They do this by computing an overhead rate at the beginning of the accounting period, and this overhead rate is called the predetermined overhead rate. Companies use a predetermined overhead rate instead of actual overhead costs because they want to accomplish a couple of things. They want to be able to smooth out fluctuations in overhead costs, so they don't want to necessarily apply January's overhead to products that are produced in January. They'd rather have, one even overhead rate for the year to smooth out fluctuations in things like utilities cost and also fluctuations in production. So they could still do that. They could still get sort of an average overhead for the year, but that would require waiting till the end of the year to apply any overhead to their production, and they don't want to do that either. They need to be able to cost their products in a timely manner. So for that reason, they compute a predetermined overhead rate. And to do that, they estimate their overhead costs. They usually do that for the year. And they divide that estimated overhead cost for the year by an estimated cost driver. You've read about cost drivers previously, but generally what you want is you want to choose a cost driver that has some causal relationship to the overhead costs. The most common cost drivers that companies use traditionally are things like direct labor hours, machine hours, cost of direct materials, something that they think has a relationship to the overhead costs. Companies can actually create multiple pools of overhead, and then they'll pick different cost drivers for each pool. So instead of having one predetermined overhead rate, they may actually have multiple overhead rates and have to apply overhead a number of times. Doing that generally gets you more accuracy in your overhead allocation, but there's of course a cost that comes along with that, so companies always have to, get the right balance, get the right cost benefit for their company. When companies use normal costing, as we said, they'll start out by creating a predetermined overhead rate, and they do that at the beginning of the year. The way they use that rate is as jobs go through the manufacturing process, they'll multiply the predetermined overhead rate by the actual level of that cost driver for that job. In other words, if an actual job takes 100 hours during the month of January, they'd multiply that 100 hours times the predetermined overhead rate, and that's the amount of overhead that would be applied to that job for the month of January. Because a company multiplies the predetermined overhead rate times the actual level of cost driver, you'll usually end up with a difference between the total amount of overhead applied to all of your jobs during the year and the actual amount of overhead costs that were incurred by the company. The difference between your actual overhead and your applied overhead is called an overhead variance. Ultimately, of course, we need our financial statements to reflect actual overhead costs, not that applied overhead amount. So the variances get closed out, they get zeroed out and allocated generally to the cost of goods sold account. If the variances are large, if they're material, we'll actually allocate those variances among work in process inventory, finished goods inventory, and cost of goods sold. In any examples we do here, we'll just allocate the variance straight to the cost of goods sold account. I think all of this is very difficult to understand without an example, so please go forward to the next video and let's do a job order costing example together.